If you see a chart rounding over at a peak, the natural instinct is to brace for a crash. The pattern's name, the rounding top, literally tells you to expect the end of a run. But trading based on that name will likely put you on the wrong side of the market momentum. The textbook definition suggests that this rounded shape indicates a shift in power from buyers to sellers, resulting in a major bearish reversal. The data tells a different story. Based on an analysis of over 700 of these formations, they actually act as a continuation pattern, breaking upward 53% of the time. This creates a serious dilemma for the intermediate trader. You have to figure out if the rounded shape forming on your screen is an actual ceiling or a temporary pause before a profitable turn higher. If you mislabel this shape as an inverted scallop or a head and shoulders top, you end up applying the wrong mathematical formulas for your entry and exit targets, severely impacting your returns. To navigate this, we are going to build an ROI setup scorecard. We need strict criteria to determine exactly when this specific pattern is actually worth putting your capital at risk. Our goal here is to establish a framework that lets you confirm the direction of the breakout once it happens, rather than trying to predict the exact moment the turn begins. By treating this formation as a slow-motion trend continuation rather than an immediate reversal, you give yourself the greatest statistical edge. The first filter on our scorecard is visual geometry, starting with the even rim rule. The price where the curve begins on the left needs to be roughly equal to where it ends on the right. Looking at this chart, the horizontal black confirmation line connects point A to point B. This demonstrates the even starting and ending price levels, which must be within a 5% margin of error, required for a valid setup. This rule keeps you out of trouble. By ensuring the rims are within 5% of each other, you filter out inverted scallop patterns, which have uneven rims and completely different performance metrics. The practical trade-off here is patience. Because you need to verify both rims, you have to wait for the entire right side of the dome to fully form before you can even start applying your trading capital. Next is the half-moon shape rule. You want to see the price trend create a smooth, gentle curve, starting from the lower left, arching up, and dropping to the lower right. This smooth transition separates it from a complex head and shoulders top, which is characterized by jagged, distinct multiple peaks. You will occasionally see minor price spikes poking through the top of the dome. As long as the overall arc is intact, treat these pokes as daily market noise, rather than a reason to invalidate the setup. Passing these strict visual checks means you are analyzing the correct formation to begin with, giving you a solid baseline before you calculate risk. With the shape confirmed, the primary performance filter is broader market context. You want the macro trend acting like a tailwind, not a wall. In a bull market, upward breakouts from these turns yield average gains of 37%. If you try trading an upward breakout against the grain of a bear market, that average drops to 19%. For short sellers, trading downward breakouts during a bear market provides a distinct advantage. These downward moves are violent and hit bottom much faster than the slow, grinding upward breakouts. Combine that market alignment with a specific geometric profile, and you get what we consider the golden setup, the tall and narrow pattern. Patterns that are taller and narrower than the median yield a 52% average gain. Compare that to a short and narrow shape, which drops your expected return to 33%. Finally, we look at the trading volume. This August pattern shows exactly what you want to see: a falling, U-shaped volume curve drawn beneath the price bars. High volume at the start that tapers off at the top, then rises again at the right rim, confirms a healthy transition. It shows early bullish enthusiasm fading before smart money buyers step back in at the bottom. So a tall, narrow shape, aligned with the primary market trend, featuring U-shaped volume, represents the highest probability trade on our scorecard. Once you've identified an optimized setup, you need an exit plan. To calculate your target price, measure the vertical distance from the horizontal confirmation line at point B up to the highest peak of the dome, then add that amount to the breakout point. In bull markets with upward breakouts, this mathematical target is successfully met 61% of the time. If you want to enter the trade before the official breakout, there is an aggressive entry strategy. You buy the stock when it climbs back up 30% of the formation's total height from the right rim low. A rise of that magnitude is usually enough to break the internal, downsloping trend line that formed as the right side of the dome was dropping, signaling early momentum. The obvious trade-off is risk. Entering early increases your exposure to a busted pattern, a setup that rolls over and fails before it ever reaches the breakout line at the top of the formation. The primary technical reason these patterns fail is overhead resistance. If the stock bumps against a multi-year price ceiling, it will struggle to push through, regardless of how perfect the dome looks. You also need to look outside the chart. If the company's underlying fundamentals or related commodity prices are diverging and moving against the stock, the technical setup is likely to fail. Technical math only works if the path is clear. Before committing any capital, always zoom out to the multi-year chart to ensure you aren't buying directly into a historical brick wall. Evaluating rims, measuring geometry, and checking multi-year resistance takes work. But if you restrict yourself to trend-aligned, tall and narrow turns, you secure a high-probability trade that justifies the effort. This setup is designed for patient analysts who rely on strict screeners. You have to be willing to wait for the geometry to finalize and the U-shaped volume to confirm. Do not use this shape to try and pick tops. Fighting strong macro trends based solely on a rounded peak is a fast way to drain your account. And keep an eye out for failures. If the price breaks out but moves less than 5% before reversing, the resulting move in the opposite direction is often massive, creating a highly profitable secondary opportunity. Stop looking for rounding tops and start screening for rounding turns. Use the strict geometric filters, align with the broader market momentum, and let the data guide your entries.